Focus. Ideate. Innovate. Enable. ICICI Prudential Life Insurance and CNBC TV18 present Mission Insure India. Life insurance for all.
Hello and welcome to another edition of Mission Insure India. This series is a joint initiative between CNBC TV18 and ICICI Prudential Life Insurance to create awareness about insurance by talking to experts and finally drive home the point as to why insurance is a must to protect one's family. Before we get into the discussion mode, here is a small observation. Milestones in our life like marriage, buying a house, child's education, etc. ensures that we save smartly to meet these goals. But in our eagerness to meet these goals, we tend to overlook the protection part. It is either ignored or compromised. But to my mind, insurance is the only product that not only helps in wealth creation, but also ensures that your family gets the much needed protection in case of any eventualities. And our talking point today is how life insurance fits every walk of life. And to throw more light on the subject, I have with me in the studio Mr. Suresh M., CEO, Consumer and Healthcare Business of Marsh India Insurance Brokers, Mr. Sanjay Kedia, President of Insurance Brokers Association of India, and Mr. Satyan Jambunathan, CFO of ICICI Prudential Life Insurance. Gentlemen, welcome to the show. Satyan, if I were to start with you, how is life insurance a product different from other financial products? And how do we ensure that we get both the worlds, protection and return, while buying an insurance product?
Ravi, you made a very relevant start by saying that the needs that we tend to focus more on are goal-based savings. And what we may not focus enough on is protection. And that's where the insurance product construct is. It's a combination of the savings element and of the protection element. Now, if I were to compare this product with what is offered by other industries, the savings is similar to what is offered by others.
Okay.
But the really unique and distinct part of the life insurance product is the protection element of it. So if I were to take a very simple example and say that I have a goal to save towards.
Yeah.
If I'm doing it in a pure investment product, I have to be alive and I have to contribute to it.
True.
The beauty of the life insurance product is whether I'm alive or not, once I've started contributing to a savings goal, I will get there. And that is the role that insurance plays. And that is the key difference between what is offered by an insurance product versus any other financial product that's available.
Okay, but when I look at the insurance product, there are any number of products available in the market. There is term plan, there is ULIPs, there's endowment plan, money back plan. So could you explain in brief what these plans are and how do I go about selecting one of these plans which suits me or my family?
The common theme across all of these product constructs is protection. What is different is how we save. And that's where the basis of decision of an individual customer needs to be driven by. At one level, I can have a goal.
Okay.
So I have a goal towards retirement. I have a goal towards saving for my child's education. These will determine the category of products. So I could have a retirement product, I could have a child savings product. On the other hand, I could have a platform which is about how much risk I can take as a customer. If I'm willing and able to take risk, then a unit-linked product is something which is top of mind.
Okay.
If I need the comfort of some guarantees in the products that I want to save with, then a participating or a guaranteed return product is a suitable option. So eventually, the choice of a product for me as a customer gets driven by what is my need of protection, what is the goal that I'm saving towards, and what is the risk appetite that I have in my context of affluence or wealth or savings that I already have.
Okay, let me get Sanjay in. Sanjay, from his talk, I could understand term insurance provides a protection to one's family. So should every member of the family go for term insurance? How do they decide what is the right value to buy for the family of oneself?
I would say every breadwinner who has dependents and not adequate financial support in case of a demise of the breadwinner should certainly have a term insurance product. I think the term insurance product is a pure risk product, which is a product which is not available as a comparison product from any investment or savings product from mutual fund or any other class. It's cost effective and a great value for the policyholder. And how should one go about it? The simple approach as a concept is, what is the risk? And the risk is a function of what is the expense a person would incur in the absence of the breadwinner.
Okay.
So what are the expenses the family has? What is the underlying inflation? What is the age? And more importantly, what are the liabilities? They can really change the dynamics. A big loan.
So is there
I
any
think all
thumb rule
these
how much I
factors-
should cover a family of 5?
I think a good thumb rule, without getting into a lot of science and the data around this, I would say 10 times the annual value of the income to 25 times, depending on what is the age and what are
Yeah.
the liabilities.
Okay, when I go and buy insurance product, there are different riders attached to it. There is critical illness, there's accidental death, etc. So could you share some insight on riders and which should be bought by every person? And how do I decide which is good for me or for my family?
So each rider provides a coverage which is unique, distinct, and should be relevant for the individual. So for example, if I were to look at it from my perspective, if I have sufficient life insurance cover, one of the risks that I need to be conscious of is with advancing age, if I find myself more susceptible to, let's say, cancer or a severe heart condition,
Okay.
it is quite possible that I may have a cost of treatment which is very, very large for that kind of a treatment. And therefore, if I were to buy a cover which meets that cost or is contributing to that cost, what would be called a critical illness cover, it's very useful.
Okay.
However, if I'm looking at a situation where maybe I travel a lot, I'm far more exposed in my day-to-day lifestyle to something like an accident, having an additional layer of accident cover could be seen to be valuable. So I have to determine, depending on where I am in my life stage, which of these covers adds values. A rider is only a way of adding another cover and a benefit to a core product that you're buying as a customer.
If I was to add to what Satyen said, once insurance education is much more appropriate, the life insurance market compared to the non-life and the health insurance market offers critical illness cover in a very interesting way. It based on the diagnosis, a lump sum, which is very different from the regular health cover where it is based on hospital cost reimbursement. I think that distinction is very significant for people when they buy the policyholder as a policyholder. So I think this is a great value which a life
Actually, I
insurance
want to pick
market
up from
does
what he said. If I take an insurance with critical illness and also
Yes.
take a Mediclaim, can I make claim from both the sides?
It's actually complementing cover. A medical insurance helps you get the cost of treatment for normal treatments. Most medical insurance covers will have a ceiling of how much will get reimbursed.
Yeah.
A critical illness cover actually kicks in beyond that from what it is seeking to cover. But if indeed you have a situation where, let's say, there is a cancer diagnosis which triggers a critical illness,
Okay.
the cost of treatment can be claimed from the medical insurance, and the critical illness is a standalone claim that the customer can make, and he'll get both.
He'll get both.
He'll get both.
Not an issue. Sure.
Ravi, if I have to add on to that,
Okay.
the way the critical illness under the life insurance is looked at is to also fulfill the expenses beyond hospitalization, because many a times the alternate treatments,
Yeah.
the expenses on rehabilitation are not covered under the health insurance or in general
Yeah,
insurance.
true.
And that is where the critical illness
Your daily
comes
visit
into
doctor,
handy.
path lab or specialist, that is not
Absolutely.
covered.
Yeah, and that kind of helps you to, again, address the main issue, which is the financial safety net for the family, so that they don't have to wipe off the savings.
Oh, since I'm with you, what the basic premise of life insurance has always been protection. Many insurers are promoting ULIPs
Yeah.
as a long-term savings and wealth creation tool. Could you throw some light on some of the features and benefits of ULIPs? The caveat the buyer needs to be aware of, and benchmark returns on what ULIPs offer.
Yeah. So wealth creation is equally important like having a financial safety net. And ULIPs have been proven a great value when you look at a 5+ year horizon period. And generally, when you look at the benchmark values, it is anywhere between 4% to 8%. So it is always advised for someone to look at what are the instruments available to beat the inflation, what are the instruments that are available from a long-term corpus accumulation, and ULIPs are the ones that comes in handy there. Start early so that you are able to accumulate enough funds, and with the compounding factor that typically has in the investment front, the 4 to 8% that you save can actually get you the enough funding at the time of retirement or for any of these needs.
Well, the discussion is getting very interesting, but we need to take a short commercial break. We'll be back soon. Stay tuned.
ICICI Prudential Life Insurance and CNBC TV18 present Mission Insure India. Life insurance for all. ICICI Prudential Life Insurance and CNBC TV18 present Mission Insure India. Life insurance for all.
Welcome back. We are discussing about protection and how life insurance as a product fits every walk of life. Suresh, every parent wants to protect their children. So they take various kinds of insurance. There is children's education, there is marriage, or to meet various financial goals. So are these plans better than the traditional products that are available in the market?
Yeah. So children bring a lot of joy. At the same time, it brings a lot of responsibilities. And life insurance is one of the goal-based savings approach as well. So when you're looking at children, the events that you mentioned, the higher education, sending them abroad, the marriage, and so on and so forth, requires certain returns to come in. Today, life insurance offers those things, wherein you have products which can give you partial payouts on an event. So, for example, if you're having a higher education, you get a portion of the money. At a marriage, a portion of the money. Then there are products which offers you a lump sum payout in case of the demise of the parent. And there are waivers now available wherein in an unfortunate death of the parent, the premium is now paid by the life insurance companies so that you do not compromise on the children education needs or the long-term goals. So even in case there is an untimely death, there is a lump sum payment that happens to meet the immediate needs, and then the premiums are continued by the life insurance on behalf of the parent so that the long-term goals are also achieved. So one should look at all these three combinations when they're planning for a child plan.
Okay, let me get Satyan. Satyan, how are life insurers applying the principle of customer-centric design thinking to deliver a compelling end product?
At the end of the day, what we are offering is a concept. It is not something tangible. People cannot see and feel it in their day-to-day thing. And therefore, value is seen by customers only if they see from start to end value being delivered. And therefore, this entire concept of how innovative thinking or design thinking actually comes into products is in the context of this end-to-end thing. It can start with a product, a new kind of a cover. We discussed the critical illness cover. When it came about, it was a very, very interesting concept as a supplement to a medical insurance. Over a period of time, we have seen more and more kind of covers come through. That's one kind of innovation.
Yeah.
The second kind of innovation is the buying experience of the customer. A lot of the thinking is also not just about what I'm offering, but about how convenient it is for the customer to buy. So part of the thinking there has to be how do I deliver a pure, seamless buying experience from a customer's perspective. Last but not the least, the moment of truth for the customer is at the time of claim. And therefore, the delivery of how quickly an insurance company is able to settle the claim is also one where a lot of thinking goes.
Okay.
It's not just enough to settle a claim. It's also very important to settle a claim quickly because that is the financial need of the customer.
So how fast can a customer get his money if some eventualities happen?
In our own case, the average time that we settle a claim in normally is 2.5 days.
2.5 days. Oh, that's very fast. Now I'm going to open the floor to the audience to ask questions to the eminent panelists here. So anybody who can ask questions.
I'm Reshma Ajbani. What is the right age to buy a retirement insurance policy?
The day you start earning, the very first thing that you should talk about is the investment and protection. So the early you start, because the compounding factor and the age factor is on your side. So you should always look at having the life insurance at the early age. There is a concept called human life value, which states that you should start early to have enough protection. And the good part is, in the life insurance, the premiums are fixed upfront. So if you are healthy and if you are at a young age, your premiums are determined on that basis, and you can have it up to the retirement age as well.
Just to ask, add to a question, what should be at the young age? What should be the premium I should be willing to pay? It should be 10% of my salary or 5% of my salary? What should be the yardstick to make?
A financial advisor looking at the kind of expenses that you have or the needs should be able to determine that, because you always need to look at the liabilities. For example, if you have taken a student loan,
Okay.
The immediate priority would be to clear off the student loan while having an appropriate life insurance. So there is no thumb rule as such,
Okay.
but you
There's
need
a
to
case
look
to case
at,
approach.
and the good part, and Satyan can add here, is that life insurance can also offer a variable factor wherein as your earning goes up, you can revise your premium spend.
Oh,
so
basically
that
you're saying you
get-
can step it up, you see.
Yes, you can do that.
Okay, next.
I'm Tushar Shinde. My question is, it is better to buy policy online or through an agent who is giving us proper service?
Yeah, that's a good one. Buy policy online or go through an agent.
See, world over and in India, online is the future.
Yeah.
But what is the right distribution mode depends on the individual customer. Agents have done a great service to this country and to this industry by proposing insurance in a big way on the life insurance. But I would like to simplify a thumb rule. We see brokers as the biggest distribution mode for corporate buying on the life. Agents has been the largest. And you also have something called online aggregators, which have come in a big way in the market.
Yeah.
So I think all the distribution modes exist, but I think what as a customer you should look at is your convenience, the cost, and most importantly, I think all of us know when you particularly buy life insurance is the claims behavior. And one piece of advice of us to leave on the program is that when the form is filled up by your distribution partner, don't sign those blank forms and then later repent that what happens on the claim. I think these are some of the things so you need to really take charge of, and rest is really your need.
So basically technology is here to play.
Yes.
But I think they are looking for reassurance if there's some, like, so touch and tech both go to
Absolutely.
hand in hand, you're saying.
Convenience, cost, and claims. Three
Convenience,
factors
cost, claims.
determine your.
Does that answer your question? Yeah, sure. Next one.
Hello everyone. My name is Rajiv Bhatia, and my question to you is, why does term insurance and health plans offers us zero returns even if we don't claim during the policy tenure?
I'm trying to protect the future of my family. I can do it. If I have wealth, I don't need to protect. Because I don't have wealth, I'm trying to protect their financial interest. And the most efficient way of doing it is to do it without creating an investment out of that. So let's take a very simple example. Let's say I want to leave behind 1 lakh for my family. I can do it if I had the money by paying 10,000 every year for 10 years. Or I could do it by buying a pure term insurance product where my cost may not even be 10,000, it may actually be just 500 maybe. If I can actually provide the same security for my family at 500, which when I am young and not earning much, more affordable, why should I not do it? So in our mind, we should separate the concept of what I am insuring for and what I am saving or investing for. Return I expect from saving. Peace of mind I expect from insurance.
Thank you very much.
Yeah. So you can have the cake and eat it too. That's what he's saying. Okay, before I go to the next question, how many of us here have insurance covers? Can you throw your hands up? Very impressive.
We have
Very
the most
impressive.
literate.
Yeah. Okay, the lady wanted to ask you a question.
Hi, I'm Archana Jain. My question is, which life insurance policy I should buy, ULIPs or traditional plans?
Yeah, this is a confusion I think, among a lot of our viewers and readers saying that what should they go for?
At a
Both of
very
us, anybody, everybody can add, yeah.
At a very simple level, whenever I'm deciding on where to put my money, I will never put all of my eggs in the same basket. I will diversify it over a range of products and instruments. The reason I do that is because I have an appetite for risk. I don't want everything to be exposed to the same risk. The kind of insurance product that you buy or the kind of financial savings product that you buy, no matter which promoter, is also similar. You may not want to put everything into one basket. At one level, you may want to say that I want some portion of my income to be assured. At another level, you may say that I also want to participate in the economic growth, the market growth, and get some more return and upside over a long period of time. These are two very, very different risk appetites. So your choice of products, the way I see it, should be 1, diversified, 2, based on what is your comfort and what do you need out of taking risk in that product.
I think a lot of interesting questions from the audience. And I hope the audience is happy with the answers the experts have given here. I think we could go on, but we need to wind up the program. Thanks a lot, gentlemen, for being on the show. It was great having you here. Thank you very much.
Thank you.
Thank you.
ICICI Prudential Life Insurance and CNBC TV18 present Mission Insure India. Life insurance for all. Focus. Ideate. Innovate. Enable.